my mind, if you look at credit growth and if you look at the medium-term perspective, I think there's a lot of improvement in terms of the sentiment and also the fact that it has become much more broad-based as compared to previous quarters. I think you would see that in terms of credit growth numbers, it's coming from virtually all segments. It's coming from retail loans, from MSMEs, from agriculture, and also now also corporates. To that extent, I think the prognosis is very positive. But if you were to look at headline numbers, YOY growth, then I think we do need to keep in mind that, like the overall growth rate, these numbers have been flattered by the low base effect. So, to that extent, some correction might happen. But if we were to refer back to what our view was at the beginning of the year, that we might have growth which might be maybe double digit early teens, significantly better than last year, I think that's something that's likely to be borne out.
Okay, so double digits and you're likely to outgrow the market. I think you've maintained that as well in the past, Mr. Chadha. Well, let's focus on your NIMs. In the first quarter, it saw a bit of a downtake in comparison to quarter four, but quarter four had a bit of a bump up. Now the street is working with improvement on the NIMs front from here on. So could you tell us about that? Some are working with around 20 basis points. Would you concur? And also on the credit cost side, the hope is that things will cool off from here. I think you were guiding for around 1.25%, though the first quarter was very much, pleasing to the eye. What's the outlook on both these two parameters?
So let me talk in terms of the broader industry and how it's likely to pan out. So I think in terms of net interest margins, in any environment where interest rates are declining, which it was last year, where liquidity is sloshing around, it's much more difficult to keep margins intact. And I think there was a successful move by banks to make sure that liquidity management came to the forefront. Now that when we are seeing a reversal of that, to my mind, there is enough momentum in this development to make sure that margins are maintained and strengthened as we go along. Along with that, again, referring back to the previous point about credit growth, that would mean that pricing power, which had got eroded because of the fact that terms of trade, very frankly, were not in favor of banks, that is also coming back. So, to my mind, margins again ought to improve for the industry as a whole. And again, just coming to your second point, if you would just repeat that, please. My apologies.
I think you were guiding for around 1.25%. The first quarter was fairly under control. The hope is that that cools off, maybe to the 1% or sub 1% mark. Outlook on that front?
So I think there is a secular trend in terms of credit costs coming down. That has been in operation for many quarters now, and that stood even the test of COVID. Now that COVID is behind us, and also the corporate credit cycle is pretty much as good as it has been in terms of the risk profile for the past many years. I think recently we had also the statistics from CRISIL that in terms of upgrades, that's something which is far outnumbering downgrades. So I think if we would take all these things in tandem, I think to my mind, there's still some steam left in terms of the improvement of the corporate credit cycle and the overall numbers in terms of credit costs. So therefore, I would concur with the view that overall for the industry, there's still room for some improvement.
You want to give us a number?
I beg your pardon?
You want to give us a number? It can improve to what? To around 1%?
So I would desist again from giving a number for BOB at this particular point in time. But I think the broad-based improvement which has been there is likely to continue for the industry and presumably for the bank also.
Okay, I just had one follow-up on the earlier comment you made about credit growth being in the teens, you said, and the double-digit growth is perhaps what you're looking at. Can you break that up for us in terms of what the retail growth could look like? How is SME loan growth shaping up? And also on the corporate side, because a large banker last week told us that corporate loan growth is coming back in a big way. Would you concur with that? And if you can share any numbers?
So I think if we were to refer back to the results that we had reported last quarter, what you find is that the growth momentum as far as retail is concerned, that is picking up, right? It is still very strong. It was strong through COVID and is picking up. As again, I think Gautam, again, a previous speaker spoke about, again, the automobile industry, car numbers. So I think there's a lot of, also again in terms of developers, right? So I think there's a lot of secular positive trends which are in place to ensure that retail credit growth continues in terms of momentum. And also, if you see whatever the impact of the recent rate rises has been, I think that's something which has been well absorbed by the market. Along with that, again, if you go to add the relative improvement in corporate credit growth, which again for banks like ours is nearly 45-50% of the balance sheet, it has a disproportionate impact on the overall numbers. So yes, I think I would be quite sanguine in terms of the current growth momentum continuing, particularly because corporate growth is still, to my mind, likely to be significantly lower than overall retail growth, but it's still, as compared to the last few years and also the last year, significantly better.